Do you still think property is a good long-term investment?
Yeah, totally.
Done.
Easy question. Next one.
Only with finance?
Yeah, so I think that's a really interesting area, because I do think if you look at the long-term returns of property in the stock market, they're roundabout equivalent. Look, you can slice it in different ways depending on time periods and stuff, but it's more or less the same. In which case you go like, well, why would I even bother with property then? Because it's so much more hassle, it's so much more lumpy and illiquid and all the rest of it. But it's the leverage aspect that boosts your returns. And so I don't particularly, a lot of people will get into property investment going like, I want to invest in property because I like it, I understand it, but I want to do it with cash because I don't like debt. But I think debt is largely the point of it. And you've got to use it in a sensible way and control it and all the rest of it. And it does involve risk, which is why it's in that improved bucket. But if you're not using the debt, then you're taking on quite a lot of extra work for not really any extra return.
And I think in the past, because property prices in the main just rose, it was okay to buy cash because you would know you would get a return on that. But now, let's say property prices stay flat in real terms, or they could fall backwards. If you're buying cash, your asset is declining in value or staying flat. Whereas with the leverage, and you put a tenant in that pays off the leverage, you essentially make that as the gain, don't you?
Yeah, and the whole point about having like inflation being baked into the system, then it's like, well, if you've got a debt which is fixed, so you borrow £100,000, that's always going to be £100,000. But the value of that £100,000 is going to shrink relative to the value of the asset, which will go up in line with inflation over the long term. With the income stream, the rent will go up in line with inflation over the long term, and probably your earning power as well. So whatever it is that you're using to pay the debt off, or whatever you're looking at it relative to, the debt is shrinking at quite a pace.
So you don't care about yield on day one necessarily. I mean, it'll be there, but you're not thinking, oh, this is a 5% gross yield for life. You're thinking, actually, in 20 years, it'll probably be 15% on the cash I put in.
This is it. And you've got to be careful when you talk about it, because you definitely don't want to be saying like, oh, just buy anything. It's all about the capital growth or whatever. Like, no, like you've got to be covering your costs and then some, and like, have all the protections in place. But yeah, I think, again, it's like, people obsess about small differences, like, oh, well, I get a 6% or a 7% return on day one. It's like, in 10 years, it's not going to matter, because the amount that you bought it for and your debt is fixed. And you know that over time, the value of it will go up, even if it's just in line with inflation, and the rent will go up, even if only in line with inflation. So you don't need to have a property boom. You don't need rents to go up at like 10% a year or whatever they were until about 6 months ago. It's actually better if they don't. If everything just carries on nice and easy, then over time it gets you there.
And the key bit is you've accessed that increase in inflation-adjusted rentals through 25% of the purchase price of the property. You get to control the whole asset and all of the upside with a chunk in, and you use the bank's money.
Yeah, so if you say, this is a way oversimplified example, but if you say that inflation is 2% a year and property goes up by 2% a year in line with that on average, then if you put in 25% of the money, then that's 8% on your money, if you see what I mean.
Because it's a 4 times multiplier.
Exactly. Yeah. And there's lots of reasons why that's not quite true, and there's costs and stuff like that. But that's the general logic.
So even though the purchasing power in real terms of the money hasn't increased, you've got, because you've only used a quarter of the money, you have actually increased in purchasing power.
Exactly that.
I know what comments will say. They'll say, but there's interest rates on mortgages. So it's not fixed because they're applying an interest. What do you say to that?
Well, the funny thing about that is that's so much less risky than it was a couple of years ago, because when you could borrow for like sub 2%, you knew that wasn't going to be the case forever, but when was it going to stop being the case? You didn't really know. But now rates are back to close to their long-term average. Obviously, if you already owned a property and your interest rate's gone way up, that's a problem. But if you're just coming into it now, then it's like, okay, well, what's the interest rates went up by like 250% or whatever, from like 2 to 5. What's the chance of that happening again? Almost nothing, because everything in the world would collapse. So it's just like there's so much less risk around that than there was. You still need to have the headroom built in. All mortgage lenders will stress test you to make sure you can deal with it. But yeah, obviously it's a risk. You can't fix forever like you can in the US, but it's a lot less risky than it was a couple of years ago.
Yeah. Do you turn away deals in the past that were as next to nothing rates because you knew that if the rates went up, they weren't viable?
Yeah, we always tested things against a higher rate because you can't assume that it's going to be there forever.
Plenty of people did.
Plenty of people did, yeah.
Yeah.
Because it's hard because like there was a BBC calculator that's been up on the internet for like at least 20 years. I can just remember it being there, and it was always like, your interest rate now is this, but what would it be if it was 12%? And at the time, because this was like in the early 2000s, that was like a realistic thing that you could, but that you could look at and go, it could happen.
90s,
yeah, and because of where interest rates were at the time, when rates were like zero, you look at this 12% going like, what are you talking about? And now it's just like, well, now it feels a bit more like, well, that's only a doubling. So like, okay, maybe you could see it. But I still fail to see how rates can get there because like, people go, oh yeah, interest rates were 15% or whatever. And they were, but they weren't for long. And they were when everyone's debt was way, way, way lower.
This was a clip from our interview with Rob Dix about myths about money. For the full episode, click right here.